All right, let's dive into a real head-scratcher from this earnings season, Jeld-Wen. We're going to try and solve a market mystery today, which is how a company with sales literally falling off a cliff managed to have one of its best days on the stock market in years. So this is the core question, right? How does this happen? I mean, on the surface, it makes absolutely zero sense. But as we're about to find out, the real story, the one that investors were actually trading on, was buried way, way deeper than the headlines. I mean, look at this. This slide just lays out the paradox perfectly. On one hand, you've got revenue down a steep 16.5%. Ouch. But on the other hand, the stock price explodes up 26% on the exact same day. These two things just don't belong in the same universe. So what on earth did the market see? Okay, so to solve this puzzle, we have to start by decoding the numbers themselves. The real answer starts to show itself once you look past that big, ugly revenue number and dig into what was going on underneath. And here's our first clue. Check out the regional breakdown. That huge revenue drop, it was almost entirely because of a massive, nearly 22% collapse in North America. Europe, on the other hand, was actually pretty stable, down less than 3%. So right away, that tells us this wasn't a global problem for the company. It was a North American housing market problem. And this brings us to one of the most important rules in investing. It's all about the expectations game. In the world of earnings, bad can actually be good if everybody was bracing for something that was way, way worse. And that is exactly what happened with their earnings per share. Wall Street analysts were fully expecting the company to lose 11 cents a share. Instead, Jeld-Wen came in with a loss of only 4 cents. That's a 7-cent beat. It was the first sign that, you know what, maybe things inside the company weren't as bad as they seemed. And it was the exact same story with revenue. Yeah, that 16% drop looks awful in a headline, but the final number actually came in almost $11 million higher than analysts feared. So in both cases, the bar was set incredibly low, and the company managed to step right over it. That gave investors their first little spark of optimism. So, okay, the results were less bad than everyone feared. But that alone doesn't get you a 26% rally. Not even close. The next really big piece of the puzzle is all about management strategy and the story they told investors. This quote from the CEO, William Christensen, really says it all. The message they sent to the market was super clear. Look, we can't control the housing market, we can't control interest rates, but we are going to be hyper-focused on fixing everything inside our own four walls. And you know what? This wasn't just talk. They laid out a concrete, actionable plan. They were talking about serious cost cuts. They mentioned footprint actions, which is just a corporate way of saying they're shutting down entire facilities to get more efficient. And maybe most importantly, they talked about fixing customer service to win back trust. This showed a team that wasn't just hiding from the storm, they were actively trying to rebuild the ship in the middle of it. Beating estimates is good. Having a turnaround plan is great. But neither of those things typically adds up to a 26% stock pop. No, the real fireworks, the thing that really lit a fire under the stock, came from one single announcement. And that was bringing back their full-year guidance. Now, guidance is basically the company's official prediction for how they'll do. A while back, Jeld-Wen had withdrawn their guidance, which is like a pilot coming on the intercom and saying, "Folks, I have no idea where we're going." So bringing it back, that's one of the strongest signals management can send that says, okay, the storm is past and we can see the horizon again. And here's the wild part. The numbers themselves weren't even that great. They're still expecting revenue to be down for the full year. But that wasn't the point. The simple act of putting numbers out there, of giving investors a map for the rest of the year, that was the absolute game changer. It put a floor under the stock. So if you take one thing away from all this, it's this. The market's crazy reaction wasn't a reward for a good quarter, because it wasn't a good quarter. It was a reward for a signal. It was management telling Wall Street, we believe the business has hit the bottom, and the worst is officially over. So let's put on our analyst hat. What does this all mean for the road ahead? Where does Jeld-Wen go from here, and what should we be watching for on their next earnings call? Okay, so here's our checklist for the next quarter. First, demand. We need to see any sign that the housing market is turning a corner. Second, pricing. Are they holding their prices or are they having to discount to keep sales? Third, we need proof, real, hard data that shows their big transformation plan is actually saving money. And fourth, the big one, a clear plan for their debt, which the CEO promised to deliver by the end of the year.
So here it is, our official take for the next call. We think their results are going to come in right in line with their new guidance, proving they can be trusted. We think the stock is still going to be volatile, but that this quarter helped build a new floor underneath it. And for that reason, we're giving it a market perform rating. They've bought themselves some serious credibility, but now comes the hard part. They have to execute, quarter after quarter. In the end, Jeld-Wen's wild quarter is just a powerful lesson. It proves that sometimes the market cares less about the past and a whole lot more about its perception of the future. The big question now is, can management turn that perception into a new reality? We'll definitely be watching. This is not financial advice.